Welcome back to Investing Talk Podcast. Today we're tackling a really interesting one, a stock that gets a lot of attention, DraftKings. Lots of volatility there. Our goal here is to sift through, the recent filings, what analysts are saying, the technical charts, everything, to try and answer that big question. With the price pulling back like it has, is now a good time to maybe get in. Before we jump into all that, though, please do take a second to subscribe, maybe like the episode, leave a comment. We really do appreciate the feedback. And yeah, if there's a company you're curious about, one you want us to look into next time, definitely drop it in the comments below. We'll add it to our list. Okay, so DraftKings. Let's start with what seems like a bit of a contradiction, right? The recent performance versus the stock price action. Because those Q2 2025 results back in August, they looked fantastic on paper.
They really did. You saw revenue hitting $1.51 billion. That's a 37% jump compared to the year before. That's substantial growth.
Yeah, and it wasn't just the top line. Monthly unique payers climbed to 3.3 million, so they're still pulling people in.
Right, and that 37% jump, it wasn't just new users, which can be expensive to acquire. A lot of that strength, came from better engagement, more efficiency. We're starting to see that ecosystem they talk about really working, fantasy players trying the sportsbook, maybe checking out the casino later. That cross-selling boosts the average revenue per user, the ARPU, and that's really the name of the game for long-term profitability.
Okay, that makes sense.
And management seemed pretty confident, too. They reiterated their full-year guidance for 2025, the $6.2 to $6.4 billion range, and said they were aiming for the higher end of that.
So, strong quarter, confidence from the top. You'd think the stock would be flying. But then October happened. Shares dropped, nearly 5% after Jefferies cut their price target.
Yeah, that definitely spooked the market a bit.
And the stock went down to around $33. That's a long way from the highs we saw back in July, up near $45. So what gives?
Right.
Why the disconnect?
Well, that's really the core of the issue here. It seems like there's a real split among institutional investors. You've got one camp, the growth folks, who see that ecosystem, the ARPU growth, and the big market potential. They're focused on the long game.
Okay.
But then you have others, maybe more value-focused or just more cautious, who are worried about how fast they can actually turn profitable, with all the competition and the money they spend on promotions.
Right. The ad spending is intense.
Exactly. And we saw that division really clearly in September. You had Weiss Ratings slapping a sell on it, citing valuation concerns, maybe cash burn worries. But at the same time, Oppenheimer kept their outperform rating, even though they did trim their price target a little.
So major players disagreeing, that creates CHOP, instability.
Precisely. When the big money can't agree, the stock tends to get volatile and often pulls back because that uncertainty makes people nervous about, how quickly they'll actually make money consistently.
So for you listening, the big question becomes, does this split, this decoupling of the strong business results from the falling stock price represent an actual opportunity? To figure that out, we need to kind of zoom out from the daily price swings and look at the underlying business. Yeah. The fundamentals. What's the real health at DraftKings?
Yeah, and when you do that, when you look past the immediate noise, the fundamental picture is, it's pretty strong. We're talking about, for the full year 2024, revenue of $4.77 billion. That's a 30% increase year over year. That kind of growth is vital if you want to grab market share in this, booming U.S. betting market.
30% is still impressive growth.
It is. But maybe even more important is the trend towards profitability. Now, look, they're still losing money. That's pretty typical for a company expanding this aggressively state by state.
Sure, land grab phase.
Right. But the losses are shrinking significantly. The net loss for fiscal 24 was $507 million. Sounds like a lot. But compare that to the year before, fiscal 23, when they lost $803 million.
Wow, okay. That's a big improvement. Almost 37% better.
Yeah, exactly. It shows they're getting much better at managing operations, becoming more efficient even while they're growing.
That's definitely encouraging, trimming the losses like that. But let's be honest, this online betting space is incredibly competitive. You've got casinos, media companies, everyone piling in. So what's DraftKings' actual competitive advantage? Their moat, right? What stops them from just having to constantly spend fortunes on promotions just to keep up?
That's the million-dollar question, or maybe billion-dollar question here. Their moat isn't really about some secret tech nobody else has. It's more about a few key things working together. First, just sheer brand leadership. In most states where betting is legal, they're either number one or number two. That name recognition, that trust, it takes a lot of time and money for a newcomer to build that.
People know the name.
Definitely. Second is that ecosystem integration we talked about, it creates stickiness. If you use DraftKings for fantasy, maybe you try their sports book, then maybe you try iGaming, the online casino stuff. It's all connected. It makes it harder, or at least more hassle, for you to just switch to a competitor who maybe only offers one of those things.
Like, it keeps you in their world.
Exactly. And third, their financial position is pretty solid. They have good liquidity, not too much debt. That means they can afford to keep investing, keep pushing into new states, maybe launch new iGaming products without desperately needing to raise more cash right away, which could dilute existing shareholders.
So they can potentially outlast some smaller competitors in those promo wars.
That seems to be part of the strategy, yeah, staying power.
Okay, so fundamentally there's a strong case. Improving financials, decent moat. But for a lot of people thinking about buying now, the technicals have to line up too. We know the stock's been beaten down, trading in the low $30 recently. What are the charts telling us? Is this the bottom of the dip, or could there be more pain ahead?
Well, the charts definitely confirm that it's been a rough patch, a deep correction. Right now, the stock is trading significantly below its key moving averages. The 50-day moving average, which kind of shows the shorter-term trend, is way up around $44.
34.
And the 200-day, which is more of a long-term trend indicator, is sitting around $40, trading below both of those signals that the recent selling pressure has been pretty intense.
Not ideal, technically speaking.
Not ideal for the immediate trend, no. But here's where it gets interesting, especially if you're thinking shorter term. We look at something called the 14-day Relative Strength Index, or RSI. Basically, it measures how fast and how much the price has moved recently. Think of it like measuring momentum.
Okay, what's that RSI number looking like for DraftKings right now?
It's currently at 29.4.
29.4. What does that mean?
Generally, a reading below 30 on the RSI is considered oversold territory. Imagine stretching a rubber band down, down, down. The further you pull it, the more likely it is to snap back up, right? An RSI this low suggests that the selling might have gotten overdone in the short term. The downward momentum might be exhausted, which often means there's potential for a technical bounce, a relief rally.
Ah, okay. So the weak price action has pushed it into a zone where technically it looks due for at least a short-term recovery.
That's the idea. You've got this interesting setup, strong fundamental story hitting these technically oversold levels.
Which leads us back to the analysts. If the charts are hinting at a bounce, what's the broader Wall Street view on the longer-term picture, especially given those losses we talked about?
Well, despite all the recent volatility and the price drop, the overall analyst sentiment is actually surprisingly bullish. You have a strong buy consensus rating. That's compiled from, I think, 26 different analysts covering the stock.
Strong buy, okay.
And get this, their average 12-month price target is $53.23.
$53 from the low $30 now. That's over 60% upside they're projecting.
It's a huge vote of confidence. It tells you that, by and large, the analyst community believes the long-term growth story, the path towards profitability, it outweighs the current negatives and the cash burn concerns.
So they expected to break through those moving averages we mentioned.
Absolutely. That technical analysis suggests the immediate, maybe 3-month bullish range is somewhere between $32 on the low end and maybe $43 on the high end. That $40 level near the 200-day moving average is a really key resistance point psychologically and technically. Hitting that $53 target implies analysts expect the stock to not just reach $40 but blow right past it sometime in the next year.
Okay, so if that's the target, what could actually fuel that kind of move? What are the specific events or catalysts coming up, say, in the next 3 months or so that you should be watching?
Right. There are a few key dates to circle on the calendar. First up, October 31st, 2025. That's when they report Q3 earnings. Now, the expectation is still for a loss, maybe around an extra 30 cents EPS, but the market will be intensely focused on revenue and especially on that ARPU number again. Continued strong growth there could really ease those profitability worries.
Okay, Q3 earnings, end of October, what else?
Then, November 15th. That's a major ETF quarterly rebalancing date. DraftKings is in a lot of growth in tech ETFs. These rebalances can force big funds to buy or sell shares, creating significant volume and potentially moving the price. It's a good gauge of institutional appetite.
Interesting. Passive flows.
Yeah. Third, watch for updates around December 2nd. That's usually when we start getting data on holiday sports betting. The holiday season is huge for this sector. Strong early numbers could give the whole group a lift.
Makes sense. Big betting season.
And finally, December 10th is when we get the next round of institutional ownership disclosures. That'll show us which big hedge funds or institutions were buying or selling during this recent pullback. Seeing smart money stepping in could be a strong signal.
Got it. Earnings, ETF flows, holiday data, and who's buying. What about the wild cards, the rumors, the M&A buzz that always seems to float around these kinds of stocks?
Oh yeah, there's always chatter. M&A is a big one. Constant speculation about whether DraftKings might buy someone, maybe in iGaming to bolster that offering, or even in sports media to kind of deepen their content connection with
Or
users.
maybe get bought themselves eventually.
That's always a possibility too, though maybe less likely near term given their size. Then there are the rumors about international expansion. Moving beyond the US would obviously open up huge new markets.
Right.
And don't discount the power of a big partnership announcement. A major deal with a celebrity or a new league partnership could really drive brand awareness and bring in users more cheaply than just ads.
So, potential upside surprises. But we have to talk about the risks too. What are the main things that could derail this bullish outlook?
Absolutely crucial to stay balanced. The number one risk, without a doubt, is still the intense competition. Those promotional wars we mentioned, giving away free bets, deposit matches, they're brutal and they squeeze profit margins. That directly impacts how quickly they can become consistently profitable.
Yeah, seems unsustainable long-term for everyone.
It does. Second is regulatory uncertainty. Gambling laws are state by state. A negative change in rules, maybe higher taxes or tighter ad restrictions in a big state like New York or Pennsylvania, that could really hurt.
Always a risk in regulated industry.
For sure. And lastly, something that's probably contributed to the recent weakness is the sort of background concern about newer competitors like prediction markets. They're maybe more nimble, lower cost, and could potentially steal some casual bettors away. It's something to watch.
Okay, so competition, regulation, and new potential threats. Got it. This has been really thorough. We've got the strong growth, the improving loss picture, a decent competitive position, but a stock price that's taken a beating and now looks technically oversold. How do you wrap this all up? What's the final take based on everything we've discussed?
Well, pulling it all together, the analysis really points towards a strongly bullish outlook right now. When you combine that fundamental growth story, the revenue, the narrowing losses, the solid balance sheet, with the fact that the stock is technically oversold according to the RSI, and you have this calendar packed with potential catalysts coming up, well, the source material actually gives it a 9 out of 10 rating.
10 out of 10? That's quite bullish.
It is. It suggests that this recent pullback has potentially created a really attractive entry point. It could appeal to, say, a shorter-term trader looking to play that potential bounce off the oversold levels, maybe around the earnings report. But maybe more importantly, it seems to validate the long-term investor who believes in the bigger picture, the market leadership, the ecosystem, and that clear path they seem to be on towards eventual sustained profitability.
That makes sense. A strong analyst target, that 53 3-hour figure, certainly implies a lot of confidence in that long-term story. So maybe a final thought for you, our listener, to chew on after this. Given that high level of institutional confidence baked into that 53 trial target, what specific new development, maybe a breakthrough product beyond what they have now, or perhaps the legalization of sports betting in a massive state like, say, Texas or California, what would it take to truly smash through that $40 technical resistance level and really launch the stock into a new, higher trading range? Something to think about. All right, thank you for tuning into this market exploration. We'll catch you next time for another look at what the numbers in the charts are telling us.